the flight to bonds during the COVID crisis caused instability in the market itself. There's a related question to that from Crypto J, who says, how high can the dollar rally before it causes global instability in emerging markets?
So it's partially how high it goes, and it's also partially the speed with which it gets there, right? So if the dollar kind of grinds up slowly over time, it get to a higher level without breaking things compared to if it just shoots straight up, which is what it did during that COVID crash. That's what triggered the foreign sector having to sell it because, if you look at foreign balance sheets, they have something like $13 trillion in dollar denominated debt, according to the Bank for International Settlements. That's mostly not owed to the U.S. It's like owed to other foreign entities. So countries in Africa owe China. Countries in South America and Turkey, they might owe European entities, right? It varies across the world, but it's denominated in dollars. And so if you have a situation where dollar-based cash flows are drying up while they still have all that debt, they have a problem. But one of the things that they can do is, the foreign sector has tens of trillions of dollars worth of U.S. assets. That includes stocks, treasuries, corporate bonds, and less liquid U.S. real estate. And so the entities that have those types of assets can sell those assets if they ever need dollars. And that's what we saw in that kind of March 2020 environment. And obviously some emerging markets are in better shape than others. So for example, Turkey's in a very rough spot because they have liabilities that exceed their assets in terms of international reserves. Whereas when you look at, a country like Brazil, they're in somewhat better shape, for example, and so they have more options available to defend their currency. We're also seeing, if you look at the dollar index, as strong as it has been lately, it's actually been more a factor of how weak the euro and the yen are. If you look at the dollar compared to a lot of other major currencies, it's been strengthening, but in many cases it's still below the highs it reached in 2020. Whereas, when you compare it to the euro or yen, that's a different story. It's kind of broken out against those. So I think that this particular dollar rally has not been as vicious on emerging markets as it could have been. But if it keeps grinding up, and especially if it goes up in a disorderly, quick way, that can absolutely put pressure on, especially the weaker emerging markets, the ones that have more debt than they have, international reserves. So Turkey's at risk, Chile's at risk. Argentina's at risk. Basically, there are a lot of these periphery countries, whereas I think other countries like China, Brazil, and places like that, they have somewhat more resiliency because they have significant reserves to offset their liabilities.
The next question, I'll couch it with the disclaimer that we do not give personalized financial advice on our channel. Neither do we ask our guests to give personalized financial advice, but we're talking about the principles involved here. Batman Gilhich as, how long can we expect the stock bear market to continue, and how deep can we expect stocks to go down? Should a long-term holder take advantage of the recent bounce in stocks to sell all the decade-long such holdings and go onto the cash on the sidelines until the end of the bear?
Well, I think so. There's always a challenge in trying to determine tops and bottoms for anyone. I generally use kind of a dial in and dial out approach, meaning that, if the market goes down significantly and sentiment turns very bearish and valuations improve, I generally put a little bit more chips on the table. I buy a little bit more equities. On the other hand, if we see, a huge rally and kind of a euphoric peak, I trim some of my equities and get a little bit more defensive. And it's not necessarily that I'm trying to time the top or bottom specifically, but it's rather that I'm just risk managing and kind of allocating around the margins. And so the first half of this decline was mainly valuations. So earnings were still holding up well, but as interest rates rose very quickly, we saw downward pressure on a lot of valuations for different equities. The second half of the year, I think the bigger risk is the earnings side. And so we've seen somewhat of a relief rally here as forward expectations of interest rates have cooled off. So that takes some of the pressure off of the valuation changes. But I think the key risk to watch going forward is earnings weakness. And I'm very kind of sector dependent. And so, for example, I think that there are energy pipelines, there are healthcare stocks, there are value oriented, dividend oriented equities out there that are trading at average or historically below average valuations, even as the broad market is rather expensive. And so I think it comes down to, it could come down to individual stock selection or sector focus. Basically, I do think there are opportunities out there. But I think that I'm kind of modeling this more like a wide band of volatility rather than kind of a just a steep fall, right? Because we still have high inflation, we still have negative real interest rates, so it makes it challenging for investors to get too focused on bonds and cash. But I do think that there is another risk of another leg lower, specifically from the earnings side. So that's what I would watch is signs of earnings deterioration from major companies. So I think precious metals give people a handful of benefits. One is that it's somewhat uncorrelated with stocks and bonds. You can have an environment where both stocks and bonds do rather poorly and gold holds up pretty well. The beginning of the year, certainly we saw that kind of gold was holding up better than stocks and bonds at first. Then it took a little bit of a tumble. It's also a decent hedge against persistently negative real yields. And so right now it's obviously been pressured by the rising dollar and the Fed tightening policy so much. But when the market starts to sniff out that they're getting to the top of their, potential tightening range, I think that can buoy gold specifically. And if you go back to what I said before about the valuations versus the earnings in the stock market, so when the stock market's being pressured on the valuation side due to tighter monetary policy, we're more likely to see everything correlated. So gold going down, stocks going down, these things, kind of all happening together. But then if you specifically get into the next stage of that, where it's less about Fed hawkishness and it's more about earnings weakness, than an asset that doesn't have earnings, gold can potentially decouple from equities in that type of environment. That's what we saw in the 1970s. That's what we saw in the 2000s. Basically, in that kind of stagflation environment, when the weakness in equities is driven by the earnings side, that's when kind of this uncorrelated asset can do well. And then, of course, the other main benefit is that you get outside money. So there are relatively few assets that you can self custody that represent portable money-like value, right? Because when you hold stocks and bonds, in cash, it's basically it's held on custodianship for you. It's an IOU essentially. Your real estate, obviously, you can hold, but it's not portable in any sort of way. And so things like gold, silver, or maybe Bitcoin, these represent these self-custodial ways of people holding value that is outside of any sort of IOU based system. And so that's obviously valuable for a lot of people throughout the world, I think.
This is a kind of a interesting question. It's very specific, and it's within this realm of gold and silver. A question comes from Maxime Augustin, who says, "Is jewelry money to you, and should we count it with or without markups?"
So it's certainly money in India for starters. That there's a long tradition of gold jewelry being a store of value in India. In the United States, we see, I don't extensively use jewelry as money, but I can certainly see why people do. And there's even services now that are targeting that. I believe that one is called Mene, right? So you can get 24 karat jewelry, and so it's designed to have less of a markup and to be to more closely resemble the actual gold content than you would get in more complex jewelry or in more resilient types of jewelry. And so I think that services like that are interesting. It's actually also one of the kind of funny ways it's a way to get gold through airports and stuff, right? Because if you're trying to bring like coins and bars, you can potentially run into more issue than if you're wearing it. And that can apply to a lot of different countries around the world. Obviously, they're all going to have different laws, or regardless of what the laws are, just whether or not you get stopped, just you're just wearing a necklace. And so I do think that there is a use case for that type of approach. I just think going back to what you said, I'd just be cautious about the level of markup you pay and whether or not it's kind of the type of jewelry that is more tailored towards store value or is more tailored to being highly decorative and having a very large markup.